out there in Think Tank Land. Brian here, one half of the Think Tank guys. And I'll make a quick joke because if you've seen some of the other videos, I don't always have this beard. In this case, for this week's episode of How to Put Our Policy to Work, this beard gets me thinking, how can a single pay policy solve for a long-term care threat to our overall nest egg and our legacy and our wealth? Well, here's an example. And if you reflect back to episode number 46, a couple weeks back, I talked a little bit about how our policies actually have benefits that can assist us or help us pay for long-term care costs. In that episode, I referenced this, and because we kind of were talking about single pays a couple times over the last few weeks, I wanted to share some specifics about how a single pay can actually be a significant long-term care solution. So you're taking dollars that you were trying to hold back, trying to hold on to, afraid to put them in the market. You don't want to put them in the market and gamble them. Well, here's a way for us to maintain access to those dollars, but build in additional benefits that can be handed down to our children in a tax-free manner, much larger, in an amount that's much larger than what we've contributed to this plan, as well as handle the threat to our overall nest egg and the nest egg of the ones we leave behind from a long-term care event. So check this out. This is a single pay policy. It's very similar to ones we talked about the last few weeks, but in this case, it's specifically built for the long-term care benefits. So let's look at some of the numbers. Here I have an example of a healthy client, early 60s, who, let's just say we have some money tucked aside and we're like, you know what, let's earmark $100,000 of that cash to help us solve for this long-term care problem, but more importantly, also get the attributes of whole life policies that we've been talking about. Well, out of the gate, what happens is there's a death benefit, and the death benefit will grow to $270 and beyond over the course of a few short years. Every single year, we can expect $2,000 or so, and actually it's a little bit more than that, of guaranteed growth of the cash value with dividends. At least today's dividends expected moving forward, that number would be over $4,000 per year. So the cash value would continue to grow year to year regardless of the stock market. It's not volatile. Once it's credited to you, you get it. You guys get all that stuff. But more importantly, it has long-term care benefits built in, and over time, within a few short years, that those benefits grow, and they'll be worth over $400,000 in total, and even more as time goes by. And what's really nice is that this isn't just an expense for long-term care, and we're able to overcome the expense of any type of insurance within a few short years because of the way the cash value works. So really what we're doing is we're taking some idle dollars that are sitting there waiting for us to do something with them. And if we really just have a thought that we want to keep those back, we want to kind of hold on to them just in case, well, here's a couple just in cases that we can make these dollars work harder for us for, right? So this is a third example of how a single pay policy can put just a chunk of dollars, one lump sum worth of dollars, to work in a few different places, so that if you use it for care, it's there for you in multiples of what you've set aside. If you want it to have the ability to use it while you're still here, not for care, right? It has a cash account that will continue to grow like we know whole life policies do. And if you never use it or only use a portion of it, it has a legacy benefit worth much more than what we contributed. Any questions, just make sure you're asking Eric or I to help you walk through this. And if you're in that late 50s, early 60s, early 70s space, and you need to be thinking about, and you're thinking about this, you just speak with Eric or I. We'll clarify. We'll show you how this is an option, something to consider to control your long-term care insurance costs, but give you these other asset attributes. All right? So for the time being, you guys stay prosperous this week. And as we get close to the end of our 52-week series, anything else that we didn't address or anything that you want to hear about from Eric or I, just let us know. Have a great week.